Hello viewers, we'll be going over gold and silver futures. In this video, we'll be going over the day-by-day probability model, the technical performance of each model, how we find the models, and the day-by-day forecast for gold and silver futures. So back to the technical analysis, where I'll first go over gold futures. Today we're down 1.8% on the 1 hour chart. We are now at oversold RSI, and if we extend out further on the 4 hour chart, we are now just approaching to negative MACD. We have not reached oversold 4 hour RSI yet, and we are seeing some temporary support on the 200 moving average on the 4 hour chart. And if we extend that further on the daily chart, we may see that as our support, temporary support at the moment, as it also is the 18-day moving average, this purple line. And if we do manage to break this support level where we're currently at, I do see possible support ranging where we saw previous levels that date back to April 20th at around a price of $1,687, and that also coincides with the 50-day moving average, this yellow line. So that will be our first immediate support if we do manage to break the 18-day moving average. So if we do manage to reverse and head up higher, the next resistance that I see was made back in April 14 at around the price of $17.64. We saw that we tried to attempt it earlier this week and we failed, and we proceeded to reverse lower to where we are now at. So if we do manage to head up higher, that point to resistance is roughly around 2.5% to the upside, and to next support level, that percent movement is roughly around 2% to the downside. So let's examine the day-by-day probability model. Again, these models are now available in the link below, so do check it out. So as the days progress to the 7th day, we have a 15% chance for gold futures to climb higher between 0 to 2%. On the extreme case, we have an 8% chance for gold to climb between 2 to 4.6%. And on the other hand, to the downside, we have a 54% chance for gold futures to fall between 0 to negative 2.3%. And the extreme case, to the downside, we have a 23% chance for gold futures to fall between negative 2.3 to negative 4.6%. So let's examine the day-by-day forecast for gold futures. So we have 1 day out, that will be a Friday, and 2 days out will be a Monday. So 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? Ideally, the model that is best matched to the current trend. We have our current trend as our blue line, and overlapping it is the trend that I believe is the best match. And that trend dates back to December 1st, 2016 to March 1st, 2017. And we have our current trend right here. So let's compare the two trends. So on the current trend, we start off at the bottom Bollinger Band. We reverse higher to touch the upper Bollinger Band, and slowly revert back to the mean to the middle Bollinger Band, and once more touch the upper Bollinger Band. So let's examine the trend in question. We see a similar pattern here as well. We touch the bottom Bollinger Band, reverse higher to touch the upper Bollinger Band, revert back to the mean to the middle Bollinger Band, and once more touch the upper Bollinger Band. So what we have here is 1, 2, 3, 4 points. We also have 1, 2, 3, 4 points on the current trend. So there's a reason to believe that the trends and patterns are the same. The outcome and forecast should be fairly the same. So the model that we just examined was, say, December 1st, 2016 to March 1st. Back then, gold futures was down roughly around 3.8%. So if we examine the day-by-day probability model, that coincides with this standard deviation. We had 23% chance between negative 2.3% to negative 4.6% in the next coming days. So let's examine the technical performance of each model. On the current trend that we're in, we're only down 1.3% from monthly high, up 15% from monthly low, up 18 basis points from 10 simple moving average, and up 66 basis points from 20 simple moving average, and 4% from 50 simple moving average. So the trend that we just examined, again, December 1st, 2016 to March 1st, 2017, back then it was down 54 basis points from monthly high, up 10% from monthly low, up 48 basis points from 10 simple moving average, up 1% from 20 simple moving average, and up 4% from 50 simple moving average. So there are technical similarities among two trends. So let's now examine silver. So we'll go over technical analysis for silver futures. Today we're down 3.4%. As for the 1 hour chart, we're now also at oversold RSI. We see a slight convergence in play. And if we extend out further on the 4 hour chart, or that is the daily chart. So let's zoom in. So at the 4 hour chart, we're now oversold on the 4 hour RSI. And well, that is, like, examine the 4 hour chart. So right now, this is the 4 hour chart. So right now we saw a convergence overnight between Wednesday and Thursday. And we see a decent volume to the downside. If we extend out further on the daily chart, we were touching overbought RSI, and we may see possible support on the 200-day moving average, and that also coincides with the 9-day moving average, this blue line. So the green line is the 200-day moving average, so I'll count that as our next immediate support, and that is around a price of $16.97. As for resistance, if we do reverse higher, and I do see a next resistance level that dated back to February 21st at around the price of $18.45. That'll be our first immediate resistance if we do manage to reverse and head up higher. And that price movement to the upside is roughly around 6.3%. And to our next immediate support, that price percentage movement will be around 2.5% to the downside. So let's now examine the day-by-day probability forecast for silver futures. As the days progress, we have a 50% chance for silver to climb higher between 0 to 4%. And for the extreme case, we have a 25% chance for silver to climb between 4% to 8%. And on the other hand, we have a 25% chance for silver to fall between -4% to -8%. So let's examine the day-by-day forecast for silver futures. So we have 1 day out, 2 days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? Ideally, the model that is best matched to the current trend. Again, the blue lines are current trend, and overlapping it is the line that I believe is the best match. And that line is, I would say, it dates back to May 22nd, 2006 to August 16, 2006. So let's compare two trends. Right here where we have our current trend, we're touching the bottom Bollinger Band, continue lower lows, and then we revert back to the middle Bollinger Band, and then we finally touch the upper Bollinger Band towards the very end. So we see a similar pattern here as well. We touch the bottom Bollinger Band twice, lower lows. We revert back to the mean to the middle Bollinger Band, and towards the very end, we touch the upper Bollinger Band. So what we have here is 1, 2, 3, 4 points. We also have 1, 2, 3, 4 points. So there's reason to believe that the trends and patterns are the same. The outcome and forecast should be fairly same. So the model that we just examined was May 22nd to August 16, 2006. Back then, silver was up around 61 basis points. So if we examine the day-by-day probability model, that coincides with this standard deviation of 50% chance between 0 to 4% higher in next coming days. So if we examine the technical performance of each model, the current trend that we're in, where we're down 3% from monthly high, up 30% from monthly low, up 4.6% from 10 simple moving average, and up 9% from 20 simple moving average, and up 14.5% from 50 simple moving average. And now let's compare that to the trend that we just examined, May 22nd to August 16, 2006. Back then it was down 6% from monthly high, up 22% from monthly low, up 1% from 10 simple moving average, and up 5% from 20 simple moving average, and up 10% from 50 simple moving average. So among two trends, there are technical similarities. Again, these models are now available in the link below, so do check it out. If you enjoyed this content, feel free to like, comment, subscribe, and thank you for watching.